As we had indicated in or highlighted in one of our pre-budget columns, that the budget 2022 may have insignia of Prime Minister Modi's ambitious task of making India self-reliant and the project 2047. In other words, India's 100 year of independence and how India should be post 100 years of independence, considering that we are in the midst of celebrating 75th year of our independence and a roadmap for next 25 years. Well, our guess was right. Today the budget, which was budget proposal pronounced by Honorable Madam Sitharaman, did mention of Amrit Kal, which is 100 years of India being independent, and several proposals were announced leading up to India being a self-reliant country, and Project 2047 has a new name celebrating Amrit Kal. Now, in the backdrop of the fact that personal tax growth over April to November 2020 was a staggering 47.2% when compared to 29.2% over the comparative period of April to November 2019, and similarly the corporate tax saw an astonishing collection of 90.4% during the period April to November 2020 when compared with 22.5% during the year one of COVID, which is April to November 2019. And indirect tax on a year-to-year basis from April 2021 till date have seen a healthy, encouraging, increased trend of 38.6%. So much so, during the budget speech, the Honorable Madam Sitharaman went out of turn to cite a paragraph suggesting that the GST collections for the past month or so have been all-time high ever since GST was introduced. Although the gross tax revenue have been tepid and it only grew on an overall basis by 0.7% on a year-to-year basis, which looking at the tax buoyancy and the tepid growth in the gross tax revenue on an overall basis did not give much elbow room, and therefore we did not see any tinkering in substance with regard to the rates. Apart from minor tweaking on surcharges and aligning the surcharge rates and AMT rates of cooperatives vis-a-vis corporations, but by and large no reduction in slabs, no major changes in tax rates does suggest the fact that the government wishes to continue that buoyancy increases, and therefore there was no reason of any tax rate increase. And with regard to reduction in slab rate, well, not raising is not a relief, and Honorable Madam Sitharaman in her post-budget tax conference did suggest the fact that, well, nobody wants to sound cynical, suggesting the fact that having not raised is as much as providing a relief. But in overall context, I think the budget is a solidified proposal to make sure that India does progress in terms of becoming a strong, capitalized economy as it marches towards its 100 years of independence. What are the big takeaways if the tax rates have not been changed? Well, the budget has its usual tweakings in and around looking at changes and suggestions in modifying the scheme of the Indian Income Tax Act. Two big bang changes proposals according to me. One is bringing a code with regard to taxation of virtual digital assets with the introduction of section 115BH which suggests a 30% tax rate. Having said that, this special provision is applicable with effect from 1st of April 2022, which is assessment year 23-24. The Honorable Secretary did suggest the fact that this does not mean that currently the transaction of virtual crypto is not taxable. It is just that 115BH provides a special code and codifies the taxation of digital assets. Remember, the definition also suggests that it is digital assets, virtual digital assets, and not currency. The Honorable Finance Minister has made it abundantly clear that there is no intention to tax currency, and the fact that digital rupee, in other words, India's government state-backed currency, shall be issued in the times to come by Reserve Bank of India, and therefore it rules out any recognition, de facto or otherwise, to any forms of currency having been issued by any institution either in India or outside India. The definition also takes into consideration that currency is excluded while defining virtual digital asset. The other big bang reform which promotes voluntary compliance and perhaps aims to reduce tax litigation is the introduction of concept of furnishing updated return of income. Within a period of 2 years from the end of relevant assessment year, if a taxpayer who has not filed his return for that relevant reporting period, or having filed wishes to amend, then the scheme of the Act, by virtue of the two new provisions, section 139 capital 8A read with section 140 capital B, these are new two provisions which the bill proposes to introduce, and one could pay additional amount of 25% aggregate of tax and interest additionally, or pay an additional 50% of the aggregate applicable tax and interest put together, depending if he wishes to update his or her return within a period of 12 months, or if he wishes to update his return after 12 months, then he has to pay 50% of the additional amount of tax and interest over and above the tax and interest due. Tweaks have been made with regard to the interest provision under 234B and C. What is not very clear at this stage is whether any penalty would be imposed if such returns are suo motu updated. The finance bill does not suggest any contemporaneous amendments to section 270 capital A. So prima facie it seems that once you update your return of income, there should not be any exposure to penalty proceedings. What the updating return of income scheme does provide, that you cannot utilize this scheme or this new dispensation with regard to claim any additional refunds or any additional tax benefits. In other words, this scheme can only be used for the purposes of paying additional taxes and not to claim any tax benefits or tax refunds, so to speak. Amendments have also been made with regard to provisions of section 68 dealing with cash credits, suggesting the fact that in situations where loans have been taken, similar burden has to be discharged to prove the source of the loan, which was akin to amendments introduced few years ago with regard to proving the source if capital was invested. Similarly, to reduce litigation management provisions have been introduced to avoid repetitive appeals in case of substantial question of law is pending before higher forums in similarly situated matters. So this should reduce flurry of litigation which you may find on a solitary point. For instance, AMP matters under transfer pricing saw flurry or sleuth of matters, and similarly you found lots of appeals being filed in the recently concluded litigations in and around reassessment. So if there is a question of law which is substantial and similar issues are pending in case of other SACs, the revenue should not pursue such litigation. Treatment of cess and surcharge. The finance bill proposes to clarify that cesses and surcharge with regard to education and health and higher secondary cess are not an allowable deduction, relying on the recent decision of the Calcutta Tribunal, which cites the Supreme Court decision in CIT versus Srinivas 83 ITR 346. Section 14A gets another explanation that if you have not realized the income, still the commensurate expenditure with regard to the realized exempt income should not be allowable. Similarly, Section 37 gets another amendment in the form of situations of allowability of expenditure which are prohibited. Extension of due dates for incorporation of startup considering COVID, and similarly extension of commencement of date for manufacturing for claiming special tax treatment with regard to new manufacturing unit has been extended to 31st of March 2024. The good part of the budget, again, we did pick it up as part of our recommendations or proposal was to provide exemption or alleviate situations where voluntary crowdfunding has been received in case of people who were suffering from COVID and received some gratis amounts either from well-wishers or from employers. In case of an employee, any amount received at the time of death will not be subject to taxation in the hands of the recipient under Section 56. Necessary amendments have been made in Section 56, subsection 2, clause 10. In case of amount received on death from any other person, there is a threshold of 10 lakhs. With regard to medical relief received, there is no threshold, which is a welcome sign. Well, the Prime Minister has aptly summed up the budget as Vikas ka Naya Vishwas. I think the budget, looking at it at a macro level, more than the tax proposal, is the right step in consolidating and making India self-reliant, giving capital expenditure push, giving capex push, and making sure that the public investment will help in attracting private investment. The good sign is that not tinkering with tax rate does suggest that it's part of a big roadmap, and therefore the uncertainties associated with fiddling around with tax rates at least is a welcome sign. All in all, a good budget. Well, what have been the misses? I thought I for inflation could have been considered. Similarly, I for informal sector, and inflation precipitated by the potential increase in crude prices and other items of capital goods could have been preempted, but the government might take some proactive measures if they find interest rates do increase. So I for interest rate, I for inflation, I for informal sector were the three I's which I thought were missing. But at the same time, a good budget, step in the right direction, aims for that giant leap which India should rightfully take as one of the emerging economies. Thank you.